On April 6th, Portfolio Builder sold one half of our Boyle natural gas position for a 139% profit, and it's teetered up a little bit higher than where we sold it for. We're planning to sell the second half probably towards the end of April or early May. Right now, our top selling advisory is up a total return of 38% year to date for 2022, after returning 233% total return in 2021. This turned every $10,000 into $33,000. Prepare to sell the second half in late April or May. Looks like, unfortunately, the European conflict may become far worse in April, and this could create another energy shock in the cost of natural gas. Now, it's becoming more clear that the goal of Mr. P may not be just simply taking over strategic territories, but it may be more along the lines of creating a bond market crash and potentially dethroning the dollar, at least taking away a lot of its strength. And so far, he's winning. His currency's back to new highs, and China and India are gladly picking up all of their energy products at a discount. You must own these 4 critical stocks to protect your wealth now. Here's our current trade alert recommendation for $10,000. Now, if you had 20, just double the numbers. Step 1, buy 65 shares of UVXY. This is the VIX stock crash insurance. 2020, when we had a black swan event and the world shut down, this product shot up 1,100%. A 10% position in UVXY helps you sleep like a baby at night and hold on to your long positions. Now, so far, we've seen the UVXY fly all over the place, went to as high as $22, sold back off to $12, and it's done its job. When there was market volatility, this was rocketing up higher. The largest position we had this year was up to 18%, and it's calmed back down to the 10% range. We've made no changes to the number of shares in UVXY. We really only want to sell it if there's extreme volatility. Now, this is a new position. We're now long the 20-year treasury with leverage using the ticker TMF. Buy 139 shares of TMF. We've been out of bonds for 2 years. This is one of my favorite positions. It makes my job far easier to create steady returns, and it's called risk parity. I believe risk parity is now back after taking a 2-year break with a historic bond market crash that's been led by inflation. Now, I do believe we will peak out inflation within the next 60 days and then see falling inflation for the next 2 years. And this could be very, very bullish for the bond market. Here's a look at that chart. You can see this massive sell-off in TMF. And again, I believe this is going to be a beautiful, beautiful position to protect our portfolio in the next 2 years. You can also see how quickly yields can fall after big crashes like we've just seen. So I'm expecting TMF over the course of the next several years to break into new highs. So we could more than double, potentially even triple our money in this play. This gives you a feel for how successful bonds are typically in generating positive returns since 1977. This is the worst returning year since that period, and there's only been 5 negative years. So this is one of the safest places to put cash in general, and we've been able to sidestep a 2-year bond market crash. I do think we're very, very close to the absolute bottom in the bond market, and we'll be looking to increase this position over time. Also, here's another way to look at the bond market crash in terms of the duration and the decline. So not only is this the longest crash at 609 days, it's also the deepest crash at a 9.2%. Now, this is the US aggregate bond market, so it's not the exact same product we're trading. And here's another way to look at just how extreme this bond market crash has been, looking at the TLT in declines from the high. And typically when you see a crash like this, the very opposite reactions on the verge of happening. So we're expecting lower yields, and the main catalyst will be most likely the European conflict coming to a point of diplomacy. Step 3, buy 163 shares of ETHE. This is Ethereum, our favorite cryptocurrency. Now, ETHE is a stock ticker you can buy in your stock trading account that gives you exposure to Ethereum. Ethereum is a lot like buying Microsoft, in my opinion, only 5 years old. So massive, massive growth ahead for Ethereum to really mature. It's growing its user base faster than the internet. If you bought it in 2016 and held to today, you'd be up 24,000%. Now, ETHE, here's what your chart will look like. And again, it's just a grayscale trust that gives you exposure to the real deal safely from your stock trading account. In general, we believe governments are going to spend more than they make, and that this will drive the valuation of cryptocurrencies higher and higher over time. Step 4, buy 36 shares of BOIL. This is US natural gas prices. And in general, what we're seeing is Europe trying to slowly but surely buying less and less energy from RUSSIA. We got to be careful about what we say on these videos. And they're trying to reroute that to the rest of the world. And this is going to drive natural gas prices higher. So unfortunately, I think that these prices are going substantially higher from here. And even though we took half of our position for a massive gain, we're still holding on to one half of that position. Here's a look at BOIL. Today it's actually up to $70. So this chart's a couple days behind, but just been a massive, massive winner for us playing BOIL. This is the inflation hedge, the bond market hedge, the interest rate hedge. Now, if we look at this on a table format, you can see we have 2 defensive positions and 2 offensive positions. The defensive positions are deflationary and the offensive positions are inflationary. So we have currently in a $10,000 portfolio, 65 shares of UVXY, representing 8.8% of the portfolio. We have 139 shares of TMF, that's 3 times the 20-year treasury, representing 23% of the portfolio. We have 163 shares of ETHE, our favorite growth asset, coming in at 41% of the portfolio. Then we have 36 shares of BOIL, our inflation hedge, which is natural gas. So that is the current portfolio structure. And in general, I'm expecting to sell BOIL within the next 60 days and either rotate into a tech position, F and GU. That would be if there's real diplomacy, or to add to UVXY and TMF if we think the conflict in Europe is actually going to escalate dramatically and create a market crash. So those are the 2 outcomes we are carefully monitoring. My best guess is that we will see some sort of diplomacy and that we're going to be able to go into F and GU after we sell BOIL. But with that said, there's really very little talk of diplomacy and a lot more talk of heating up the conflict, unfortunately. Now, again, the bond market is now on the verge of crashing the stock market. We can see this channel of interest rates, and every time they get too high, it starts to become a black hole for financial markets. And so the higher these interest rates go, the more bullish we will become on bonds. Here's a look at your TLT, and we can see this trend line. And again, why does the TLT almost always go up? This is the way debt grows. Debt cannot grow if interest rates go up, up, up. And so in general, governments ensure that the debt can grow to keep the economy running smoothly and avoid a recession or a depression. The problem is it's been creating massive inflation in the last year, and now they're trying to fight inflation, which we'll be talking about in this presentation. Here's another look at the bond market. This time we're looking at the 2-year, and you can see that 2-year has gone straight up, the fastest in history. And now the Federal Reserve's talking about doing rate hikes and quantitative tightening starting in May. We're expecting 50 basis point rate hike and a $95 billion a month quantitative tightening plan. So that's what's in queue, and we'll see if they deliver just that or slightly less in early May. Yields and energy prices cannot remain at this level for long before things will start snapping. So that's our main outlook on the market. Here's a look at oil. I can get to these levels, but it cannot sustain these levels. So something will snap, and we need to carefully exit our natural gas position and most likely load up on bonds. And that's if, again, there's no diplomacy. If there is diplomacy, I would like to add to our tech positions with either the triple Q or FNGU. And again, the second the conflict ends, we want to go long a leveraged tech ETF, which we like FNGU for our high risk portfolio, or the triple Q for our safe growth portfolio. Here's a look at that FNGU. It's 12 super hot tech stocks, including 2 out of China. And this is one of the few ETFs that have given cryptocurrencies a run for their money over the last several years. And again, here's your look at Ethereum. And this is our favorite growth asset over the next several decades. Now, big picture macro, the last time the US tightened while China was expanding credit, Bitcoin returned 4,400%. We now have the ECB talking about yield curve control, which means more QE. We've got Japan saying they'll buy an unlimited amount of their bonds to keep yields lower. And we have China's PMIs going below 50 as they do a massive lockdown in Shanghai. So most likely they're going to have to start the printing presses up as well. Here's a look at that chart when we did rate hikes in US from 2016 to 2018, which came right after the Chinese housing market nearly collapsed in 2015. So this could be a very beautiful setup for cryptocurrencies over the next 2 years. It's critical you watch our webinar every Monday, Wednesday, Friday to be ready for sell alerts. Now, don't miss out on the next trade alert. If you're a free trial, call Dean now to upgrade at 505-322-7515. Okay, here's another look at the bond market. And in general, the main lesson is that for debt to grow, interest rates go lower over time. And so could interest rates go up a little higher? Perhaps, but not much more. Most likely, if interest rates go any higher than they are today, it will start hurting competing markets. So I believe we're very, very close to peak interest rates, and that we could very likely have a very bullish setup for both bonds, stocks, and cryptocurrencies to close out the year. The big catalyst will be getting those energy costs down. Now, if the energy costs don't go down, it could create another sell-off in bonds that I do believe would create a stock market crash. Now, this is the product we're playing, the TLT, but we're using the leveraged version of the TMF. And again, we can see very sharp sell-off typically leads to very sharp ramp ups in the TLT, which is what I believe we're on the verge of. Now, if we go to 120 to 115, I do think that's a level that could create extreme volatility in the stock market. So carefully monitoring this to decide if we should aggressively increase our UVXY and TMF position. And again, if it goes much lower, I will be getting very, very worried about stocks. Here's a look at the 30-year fixed mortgage rate. And again, you can see it's just gone to incredible levels last seen in 2018 in a very short period of time. And half of financial assets are houses. So this could create a massive problem for economies if the housing market starts to crash. This chart, we're looking at the 10-year Treasury against the 2-year, the spread. So we're looking at the yield curve inverting. So the very short duration debt products have not inverted, but everything from the 2 to the 10-year has at some point inverted against the 20 or 30-year. Now, typically, this leads to a bullish setup in stocks over about 6 to 18 months. And it's the steepening of the yield curve that actually ends up creating a stock market crash. So far, we're at the early stages of perhaps the steepening. Here's a look at the yield curve in another format, and we can see the front end is not inverted at all. And perhaps the 3-month 10-year is a better measurement to predict recessions. But on the 2, 3, 5, and 7, over the last week or two, we have seen it trade above the 10. In this chart, we're looking at the probabilities for rate hikes, and it's almost certain we will see a 50 basis point rate hike in May, and it looks like they will begin quantitative tightening in May as well. So we will see how the market can handle that, but perhaps it will be time to reduce exposure to stocks ahead of that event to see how that plays out. Now in this chart, we're looking at the VIX futures structure currently in contango. And again, if this were slanting down, our UVXY product would be going up. At this point, we're seeing the market price in risk in May and June primarily, and that's again when we're going to see how the market responds to what's expected to be very, very hawkish Fed policy. Meanwhile, the reverse repo still has $1.75 trillion sitting in it, which could be injected into markets. So this could be a bullish event when that drains for bonds. In this chart, we're looking at the copper to gold ratio. In general, if copper is going up faster than gold, this is predicting higher yields ahead. If we zoom in here, we can see they've been trading pretty much in lockstep. So no general prediction from Dr. Copper in terms of the future price of yields. Now in this chart, we're looking at Boyle against NRGU, which have been the two plays we've used to protect our portfolios against inflation. We sold NRGU and rotated into Boyle, and they continue to trade very close to one another. From that point, you can see Boyle slightly outperforming NRGU. NRGU is the top 10 US oil and gas companies, leverage times 3. This chart, we're looking at lumber futures, trying to get a feel for inflation or deflation. And previously, a sell-off in lumber futures last year did predict a weaker period ahead for oil. And we're starting to see that sell-off in lumber currently. This chart, we're looking at the dollar index. We're really positioned for a weaker dollar. So the returns we've had so far with the dollar rising are quite extraordinary. I'm actually expecting to see the dollar fall to the 90 level to really change our course of action. So wait to see what cryptocurrencies and natural gas prices do if the dollar was weakening, which should most likely happen as soon as energy costs start to fall. Now, a lot of problems coming out of China. They're in lockdowns again, and they've had various bond markets crashing. They've been regulating all sorts of industries. There's rumors of hundreds of millions being laid off, and they're supposedly trying to hit a 5.5% GDP target this year. They're going to need to do a lot of stimulus for this to be pulled off. And we're starting to see them begin to increase credit. In this chart, we're mostly interested to see if the currency starts to devalue, showing signs of credit expansion. In the last year, the Chinese renminbi has outperformed the dollar and strengthened, keeping their inflation relatively low, which means they have more ammunition for expanding credit than the US, who's facing extreme inflation currently. Now, in this chart, we're comparing FNGU, tech ETF with leverage, Bitcoin, Ethereum, and Polygon. Now, Polygon, you can get exposure to if you join our private equity offering, which is only available to paid customers. And that's our favorite cryptocurrency for massive returns in the near future. So you can see it's great outperformance compared to Ethereum and Bitcoin. But it comes at the cost of more volatility and more drawdown. If we zoom in a little more, we can see what's been happening as of recently. And so far, we've seen Bitcoin leading the recovery here, with Ethereum lagging behind it, and Polygon and FNGU down considerably relative to Bitcoin and Ethereum. In general, usually Bitcoin starts recoveries, then Ethereum follows, then the altcoins come in next. So very, very excited to add FNGU to our high risk portfolio, and we've been accumulating Polygon aggressively for our private equity offering. Now, this chart, we're comparing Tesla to ETHE, the Ethereum Grayscale Trust, and we're looking for divergences, and we're currently seeing one. So perhaps ETHE has a big gap up to catch up to Tesla in the near future. If we zoom out a bit, we can see just how correlated they can be at times. In this chart, we're looking at the interest rates in yellow, the NASDAQ, QQQ candlestick below, and then which we call growth, and then the value or energy companies, NRGU in green. And in general, the trend is if interest rates are rising, the value sector of the market should be as well. And over this period, since December 15th, we can see NRGU returned 131%. The triple T is up 60%, meaning interest rates have risen, while the NASDAQ's down 11%. I believe we are on the verge of a reversal in interest rates and a very potentially large rotation out of value into growth. Over the last year and a half or so, we've been bullish on value over growth, and I do believe we're on the verge of a reversal of this trend. Now, it may be short-lived, but that's essentially what we're expecting, is that the run-up in energy costs has been overdone and is due for a pullback as the global economy is slowing down from a lack of stimulus, and now central banks are preparing to tighten monetary policy. Now, again, in general, when we're going to run massive deficits at the government level, and then we're going to import more products than we export, this will weaken the dollar over time. And that's exactly what we're forecasting over a longer horizon. So what we're looking at in this chart is the outperformance of emerging markets compared to the S&P 500 during a weak dollar period. And so you can see emerging markets went up 385%, while the S&P 500 only returned 73. If we go back to that DXY chart, you can see over that period, we had the dollar index starting at 120. This is 2 years after the dot-com bubble crashed. And then they went into an easing cycle and actually ended up hiking rates towards the end here, but the dollar fell all the way to 71. This is when Bitcoin was invented. And so we can see Bitcoin's returned over 1,000,000% since its creation, while the dollar rose from 72 to 99. I want you to imagine the price of Bitcoin if the dollar were to fall even to 90 and potentially into the 80 to 70 range. That could be the true catalyst to really take cryptocurrencies to much higher valuations. Now, in this chart, we're comparing Alibaba, Tencent, and Taiwan Semiconductors, all part of the emerging market basket. And again, in our safe growth portfolio, we have a large emerging market position with ticker EDC. And what we're looking for is for Alibaba and Tencent to outperform Taiwan Semiconductors, showing that China, which has been holding back the emerging market ETF, is getting ready to stop regulating its industry so aggressively and start pumping up its stock market. And so from this date, we can see Alibaba, Tencent all outperforming Taiwan Semiconductors. If we zoom out a bit, we can see the pain that China has imposed on some of its key stocks, with Alibaba down 60%, Tencent down 37%, while Taiwan Semiconductors is only down 4%. So it looks like we're on the verge of China getting ready to ramp up credit. ECB out of Europe just said they're making plans to prevent yields from rising too much. The only way they can do that is to buy their own debt. And so with the conflict in Europe, plus the ECB claiming they may go into a bond purchasing program, this is all bullish for European stocks. In our safe growth strategy, we have a position in ETHE. It had a sell-off with the conflict, and it's nearly regained that sell-off, and we remain long that position. In this chart, we're looking at uranium, copper miners, and rare earth metals. We had Elon Musk saying that Tesla may have to get into the lithium mining business. Just year over year, lithium prices are up some absurd 200%. 3-year forecast is there will be extreme shortages of lithium. Rare earth metals, REMX, gives us exposure to lithium and cobalt miners, critical for companies like Tesla and Apple. So it's a great hedge against inflation in key raw materials that tech companies use specifically. We're not currently in copper miners, but we are in rare earth metals and uranium. A lot of people are looking at the chart of gold, saying it's getting ready for the next melt up. It's tended to do well during rate hike cycles. And we're also exploring discounts in silver relative to gold. At this point, I have not pulled the trigger on the stagflation play with gold and silver, but carefully monitoring it. Right now, I see 10 million jobs open and only 5 million people looking for jobs. So I'm not so sure we're heading towards that stagflation period just yet. The next core inflation data will come out, I believe, next week. And I believe this will be the peak inflation print of the year. Now, it may remain elevated and sticky as long as the conflict in Europe remains. So that's going to be the main bullish catalyst, I believe, for stocks and bonds will be getting those energy costs down and a resolution to the European conflict. So far, it doesn't look like that's on the verge of happening in the very short term. Here's a look at the jobs continuing to grow month over month. Here's a look at the labor force participation rate. We're still 3 million jobs behind the January 2020 level when we locked down the world. So still a lot of room to potentially go. But to get a 1970s-like inflation period, we really would need to have a lot more young people who are willing to work. So I'm not so sure we're going to have a decade of sticky inflation. I believe we do peak out. It slowly falls. And then once the energy costs go down, yeah, it can fall rapidly. Banks are lending money, so no freeze of credit. And consumers just borrowed a massive $41 billion in February. So huge credit growth, which is powering the US retail sales to new highs month after month after month. So I'm not predicting a stock crash based on this data anytime soon. United States balance of trade printing $89 billion deficit as the US runs massive, massive deficits over time. This weakens the dollar. With interest rates rising rapidly on mortgage rates, I'm watching for new home sales to collapse, but so far, no sign of that as well. Here's China's PMI, which I'm now watching drop way below 50, probably due to lockdowns. this is going to force them to have to increase credit. So we're getting that perfect setup potentially for cryptocurrencies that we saw in 2016. The only difference is we're facing far worse inflation today than 2016. And rather than just doing rate hikes, they're talking about rate hikes and quantitative tightening. So this is a new setup for markets that we will carefully navigate as we approach that date. US is done growing its balance sheet, but Europe is not. Let's check out the news feed. Okay, so they call it the cup and handle. I'm not a huge fan of technical analysis, but this is when we went into a rate hike cycle. And in the 70s was also a dramatic rate hike cycle. So we'll have to keep a close eye on gold and silver and potentially get a little silver play in. The US military is saying it does not look like there's a diplomatic intervention on the horizon. So we want to remain long either NRGU or BOIL as long as this conflict is escalating. We've got McConnell saying we need to get more aggressive supporting the conflict. So at this point, I don't see any calls for peace. Here's a look at rent versus house prices in Europe. So that'll be a sticky inflationary factor coming in is rising wages, labor shortages, and rising rent. OPEC considering cutting output as the US is getting ready to release 1 million barrels a day from the Strategic Petroleum Reserve, which is getting ready to begin. It has not yet. Here's a look at how outrageous the inflation is on a Porsche. The MSRP is $215,000, but the market adjustment is an additional $150,000. And one bad news from the conflict in Europe is a shortage of neon, which is critical for chips. So it's very problematic for the car industry. Here's a little thread from Jim Bianco saying it looks like Russia has decreased from producing 5 million barrels a day to 3. And of course, that's causing the general market to have a shortage, which is driving these $100 plus oil prices. Apparently, a lot of new drills approved in the Permian. So we might have some more supply coming online in a year or two, but that's not going to be quick. Let's see. So Pelosi was supposed to go to Taiwan this week, but then China got very upset and she suddenly had a positive test, which is why she said she couldn't go. And then we have her walking around without a mask, kissing everybody. So a lot of jokes on the internet about that. ECB is crafting a crisis tool to activate if bond yields jump, aka more QE. Massive spike in cases in Shanghai. They're testing the whole population, extreme lockdowns. They've now made it so you can't get booze, cigarettes, or strawberries, apparently only essentials. Here's a look at natural gas inventories. They have 15 days of demand left. So very, very low levels of natural gas. So good time to own BOIL, even though it's at extreme levels. We got to be careful. Once the right catalyst occurs in Europe, this could cause it to fall significantly. Here's the performance of the stock market during Fed tightening cycles. In general, it's almost always gone up. The only exception was the stagflationary meltdown in 1974, which again was massive inflation, massive rate hikes, and a massive bond market crash. But again, the labor force was far different, and the globalization of the economy that we've now done has really suppressed that inflationary impulse. Container shipping rates from Shanghai to the West are falling despite massive supply issues in Shanghai. So the setup for falling inflation and falling yields is really here. We just need those energy costs to come down. We're starting to see protests all over the world as food prices get to very high levels. Lots of starvation coming now. Durian Timmer says, how long can commodities shine? When I line up previous 3 secular bull markets of the 30s, 70s, and 2000s, I get an analog that suggests there could be quite a few years left, which I agree with, but I do think we're due for a pullback with the right catalyst. It says, perhaps the current melt up is peaking, but this chart suggests that would be just the first upcycle out of many. Ryan Dietrich says the 60-40, they're referring to 60% stocks, 40% bonds, is down 5% in Q1 of 2022. That's the bad news. The good news, the past 5 times it was down 5% or more. The following quarter was up 9, 7, 7, 9, or 13%. Bankers getting worried of shortages in metals, that this could create more losses to commodity traders. New Bitcoin conference, Peter Thiel came up comparing Bitcoin to gold, saying it could surpass the valuation of gold, and that gold could equal the valuation of the stock market if we looked at the inflation of the 70s. Very bullish speech from him. He does like Bitcoin over Ethereum. Worst lockdowns out of China since 2020, which could be there just to help get energy costs down. One of the sellers of US bonds was Japan. And I think that is the most important headlines here. Very good. Okay, so now I'm going to go ahead and hop into exact asset allocation. And if you're on a free trial, heads up, this is where your video ends. You need to call Dean to upgrade at 505-322-7515. And what you're going to get when you upgrade is access to our membership area where you can punch in how much money you want to invest in our safe growth strategy or our high risk growth strategy. And it tells you exactly how many shares to buy or sell. Okay, so